I started out without knowing anything about valuing companies. And Ben Graham taught me a way to value a certain type of company that would prove successful, except the universe of those companies dried up. But nevertheless, it was almost a guarantee against failure, but it was not a guarantee that these things would continue to be available. Charlie taught me a lot about the value of a durable competitive advantage and a really first-class business. But over time, I've learned more about various types of businesses, but you'd be amazed how many businesses I don't feel that I understand well. The biggest thing is not how big your circle of competence is, but knowing where the perimeter is. If you don't have to be an expert on 90% of the businesses or 80% or 70 or 50, but you do have to know something about the ones that you actually put your money into. And if that's a very small part of the universe.
As of 2024, Warren Buffett is the 10th richest person in the world with $135 billion. Ever wondered how he manages to consistently grow his wealth? It's not just about picking the right stocks. The key is his long-term investment strategy in value investing, which involves selecting stocks that are undervalued based on their intrinsic value. He has a well-documented love for dividends as well. These regular payments from companies to their shareholders play a key part of his investment strategy, enabling him to multiply his wealth steadily and reliably. And this video shows Buffett's dividend strategy and how you can multiply your money using case studies from his remarkable career. Warren Buffett once said, "There's a lot of difference between making money and spotting a wonderful industry." While Buffett earns substantial amounts from dividend payments, the foundation of his success lies in his ability to choose the right industries and companies within those industries. Even though dividends provide a steady stream of income, the initial focus for any investor should be on selecting the right industry. It's essential to determine whether you seek immediate monetary gains or long-term investment benefits. Buffett's approach heavily leans towards the latter. He prefers industries that offer sustainable growth and stability, ensuring that his investments can yield consistent returns over time.
There's a lot of difference between making money and spotting a wonderful industry. The two most important industries in the first half of this century in the United States, in the world, probably were the auto industry and the airplane industry. I mean, here you have these two discoveries, both in the first decade, essentially in the first decade of the century. And if you'd foreseen in 1905 or thereabouts what the auto would do to the world, let alone or this country, or what the airplane would do, you might have thought that it was a great way to get rich. But very, very few people got rich by riding the back of that auto industry, and probably even fewer got rich by participating in the airline industry over that time. I mean, millions of people are flying around every day, but the number of people who have made money carrying them around is very limited, and the capital that's been lost in that business, the bankruptcies, it's been a terrible business. It's been a marvelous industry. So you do not want to necessarily equate the prospects of growth for an industry with the prospects for growth in your own net worth by participating in it. Charlie?
Warren Buffett's investment in Coca-Cola is a prime example of his strategy of choosing good industries and companies with strong dividend potential. The beverage industry, particularly non-alcoholic beverages, has shown resilience and steady demand over decades, making it an attractive sector for long-term investments. Buffett's key eye for spotting wonderful industries led him to invest in Coca-Cola in 1988, a decision that has paid off immensely over the years.
Picture Omaha in 1937. I was 7 years old, no air conditioning, so the summers were hot and humid. People went out on their lawns at night just to try and cool off, and I got the idea that maybe I could sell them what you would call soft drinks and we called pop. I went around to a bunch of gas stations, and in those days every gas station had a cooler with varied soft drinks in it, and it had a little opener on the side and something to catch all the bottle caps. So I went around and collected all the bottle caps. I collected 8,000 of them. And then I sorted them all out, and I saw that they were Coca-Cola overwhelmed everybody else. So I decided to hook myself up to them. And my grandfather had a grocery store, so I went to my grandfather and I said, how about giving me a deal on Coke so I can sell it around the neighborhood? And he sold me at the rate of 6 bottles for $0.25, and I went around and sold them for $0.05 each, and I sold out every time. I had no inventory, I had no receivables, I had the best business I ever had. But I made one mistake. I didn't put the money I saved into Coca-Cola stock. I rectified that mistake some years later.
What excites you these days in technology, innovation, new businesses?
I like this one.
In 1988, Buffett purchased about $1 billion of Coca-Cola shares, which amounted to approximately 6.3% of the company's outstanding shares at the time. This investment marked a significant commitment to a company he believed had a strong brand, consistent profitability, and a promising future. Buffett's confidence in Coca-Cola was rooted in its dominant market position and the enduring appeal of its products. Buffett claims he will never sell any Coca-Cola stock, and here's why. See, one of the key aspects that made Coca-Cola an ideal investment for Buffett was its history of paying and increasing dividends. In 1995, just 7 years after Buffett's initial investment, Coca-Cola's annual dividend was 22 cents per share. This consistent payout provided a steady income stream, aligning perfectly with Buffett's investment philosophy of generating reliable cash flow without selling the underlying stock. Fast forward to 2023, Coca-Cola's annual dividend has increased to $1.76 per share. With Buffett owning 400 million shares, his annual dividend income from Coca-Cola alone is about $704 million. This dividend growth over the years shows the power of compounding and the benefits of investing in a company that returns capital to its shareholders. The company has managed to maintain its profitability despite various market challenges, ensuring that it can continue to reward its shareholders. The non-alcoholic beverage market is relatively stable, and Coca-Cola holds a significant market share, which has helped secure the reliability of its dividend payments. Furthermore, Coca-Cola's business model, which includes extensive global distribution networks and a diverse product portfolio, has contributed to its sustained success. Buffett's investment in Coca-Cola demonstrates the importance of selecting companies within resilient industries that can provide consistent and growing dividends. By identifying Coca-Cola as a leading player in a robust industry, Buffett ensured a reliable and growing stream of income, exemplifying his strategy of long-term wealth creation through dividends. Similarly, Buffett's strategic move in the tech industry with Apple demonstrates his keen eye for spotting wonderful industries. Despite his initial reluctance to invest in tech stocks, Buffett recognized Apple's strong market position, brand loyalty, and consistent earnings, which ultimately led him to make a significant investment in the company. According to Buffett, Apple is a better business than any other business he owns.
During an episode of Investing the Templeton Way podcast, Professor Damodaran, who he respects almost as much as Warren and Charlie, mentioned that he is not comfortable with positions becoming a large part of his portfolio, for example, when they reach 25 to 35%. He mentioned that Apple is now 35% of Berkshire's portfolio and thinks that that is near a danger zone. Wonders if Warren and Charlie can comment.
I'd like to make one comment first, but Charlie will come up with...
I think he's out of his mind.
Yeah, I knew that was coming. But Apple is not 35% of Berkshire's portfolio. Berkshire's portfolio includes the railroad, the energy business, Garanimals, you name it, See's Candy. They're all businesses. And, the good thing about Apple is that we can go up. They buy in their stock, and instead of owning 5.6%, they got about 15 billion, 700 and some million shares outstanding. They get down to 15.25 billion without us doing anything. We got 6%. So we can't own more than 100% of the BNSF. We can't own more than 100% of Garanimals or See's Candy. And it'd be nice. We'd love to own 200%, but that just isn't doable. But they're all the same. They're good businesses. And to think that our criteria for Apple is different than the other businesses we own. It just happens to be better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad. And Apple is a better business. Our railroad is a very good business, but it's not remotely as good as Apple's business. Apple, has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own 100% of, but we're very, very, very happy to have 5.6 or whatever it may be percent, and we're delighted every 1/10% that goes up. It's like adding $100 million to our earnings. I mean, our share of the earnings, and they use the earnings to buy out our partners, which we're glad to see them sell out too. The index funds have to sell if they bring the number of shares down. And, we went up slightly last year, and I made a mistake a couple of years ago, and I sold some shares when I had certain reasons why gains were useful to take that year from a tax standpoint. But having heard me say that, it was a dumb decision. Charlie, you've already given your comment about it, but we do not have 35% of Berkshire's portfolio. Berkshire's portfolio is the funds we have to work with. And we want to own good businesses, and we also want to have plenty of liquidity. And beyond that, the sky's the limit, or our mistakes, who knows what the bottom is.
Berkshire Hathaway began buying Apple shares in 2016, making a notable shift in Buffett's investment strategy. By mid-2018, Berkshire had accumulated over 5% of Apple's outstanding shares, with an investment valued at around $36 billion at that time. This move was driven by Apple's impressive financial performance and the potential for substantial returns through dividends and stock appreciation. Apple's history of dividend payments is relatively recent compared to other companies in Buffett's portfolio. The company started paying dividends again in 2012 after a long pause. Since then, Apple has steadily increased its dividend payouts, making it an attractive investment for income-focused investors like Buffett. As of 2023, Apple paid 23 cents per share quarterly. With Berkshire Hathaway holding over 900 million shares, Buffett's annual dividend income from Apple amounts to approximately $828 million. And that's how he multiplies his money with dividends. Apple's ability to innovate and maintain a loyal customer base has ensured consistent profitability, which in turn supports its capacity to pay and increase dividends. The tech giant's commitment to returning capital to shareholders through dividends and share buybacks has made it a compelling choice for long-term investors. Apple's financial portfolio has been remarkable, contributing significantly to Berkshire Hathaway's overall portfolio returns. The company's revenue and profit growth have consistently outpaced expectations, driven by strong sales of its flagship products like the iPhone, as well as growth in its services and wearables segments. This consistent performance has bolstered investor confidence and supported ongoing dividend increases. Furthermore, Apple's strong balance sheet and cash flow generation have enabled it to sustain and grow its dividend payments. The company's substantial cash reserves provide a buffer against economic downturns, ensuring that it can continue to reward shareholders even during challenging times. This financial strength has been a key factor in Buffett's confidence in Apple as a long-term investment. Buffett's investment strategy also includes investing in value stocks as opposed to growth stocks, and this is how he makes the distinction between the two.
You've often stated that value and growth are opposite sides of the same coin. Would you care to elaborate on that, and do you prefer a growth company that is selling cheap or a value company with moderate or better growth prospects?
Well, actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to, growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year. But whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful? I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case, again, is the airline business. The airline business has been a growth business ever since, well, that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public. But the growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people.
Actually, Berkshire Hathaway does not pay dividends, but Buffett still considers it a value plus growth stock because of this.
Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business, a growth stock or value stock? Who knows what they would have said. But, the real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously. And you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.
And here, in another interview, he clearly explains why Berkshire does not pay dividends.
One of the number one questions that came out this weekend was so interesting to me because I've been coming 6 years and I've never heard so many people ask, why isn't Berkshire paying a dividend? This at a time when the largest percentage of S&P 500 companies are now paying dividends, first time in a long time that they are. And then you have the fact that you own dividend-paying stocks like Coca-Cola, American Express, Intel, which just raised its dividend this morning, by the way. Why won't you pay a dividend to your shareholders?
Well, we think our shareholders 5 years from now will be wealthier, counting what they would get from the reinvestment of the dividend. We think they'll be wealthier if we hold on to the money. Now, we may be wrong in that, but historically we've been right. And if we'd paid a dividend over the years, our shareholders would be considerably poorer than they are. As long as we think we will have the opportunity to invest dollars to create more than $1 of present value, we'll retain the money, and when we don't think we can do that, we'll either repurchase stock or pay dividends.
Is there no way you will ever pay a dividend?
Oh, someday Berkshire will pay a dividend because it'll get so large that it can't use the money or all of the money that it earns effectively. But we don't think we're at that point, although we're much closer to that point, obviously, than we were 20 years ago.
Now, continuing on from our discussion of how Buffett increases his wealth through dividends, let us move on to the next point, which is his conviction regarding the U.S. economy. He often advises on buying the S&P 500 low-cost index funds. I hope this video has taught you something new. However, if you want to know his best dividend investing strategy for 2024 with only $100, watch this next video.